Today, we're going to be talking about Forex. Now, just a little caveat, guys. So this part of the lecture, this lecture is going to go a little bit fast. I'm going to take you through a lot of definitions, and we're going to be talking about a lot of stuff. And then in the upcoming lectures next week, I'm going to actually show you how it works. Okay, so for this lecture, we're just going to set the ground rules with definitions, and then after that, I'm going to show you what those definitions mean, what the definitions mean, and how we're going to apply it when passing our journal entries. Okay, so this topic likes journal entries. It's not the only thing that can be asked, right? There are other things that can be asked, but it fits well with journal entries. Okay, and this topic is specifically dealing with foreign currency transactions, and we're going to get into that now. Okay, so if we look at what sources we need to look at, what sources do we have to when studying this topic? So obviously, Introduction to IFRS, that is our textbook, and in chapter 12 we deal with the Forex part, the Introduction to IFRS. Then in our workbook, we've also got chapter 12 with the questions. Now the questions are going to be split up into two parts. There's going to be a part A, which is what we're going to start today, and what we're going to do next week, and then there's going to be a part B, which is what we call hedged instruments. So this week's stuff is unhedged, next week's stuff is hedged. So not next week, the week after the exam or the week after the test is going to be hedged, and next week we're going to do unhedged. So that hedged part, which happens and which is tested, and your questions are in part B of 12. You're not gonna do any of those questions for now, or even after the test. You're only going to do it once I lecture it, right? Because it can get a little bit complicated. So I'm trying to tell you, don't worry too much about part B. Just now. Then we've got our class notes. Like I said, I prepared the class notes for you as a starting point so that you can take the notes and then add on to them what you I've missed out or what you think I haven't done enough of in the notes, and you can then study from those notes. So ultimately, I want you to be able to study from those notes. So when we went over EPS, I told you that the EPS notes are basically complete. You didn't need to add too much to EPS notes. Whereas with these notes, I'll prepare them similarly, but I would encourage you to add things and to make it your own and to make sure that you understand what exactly is going on. Okay, so in terms of the objectives, so today we're going to go through a lot of definitions. Obviously, the objective is that you understand those definitions and understand how they interact and how they interrelate. And then we're going to start doing calculations next week about foreign currency transactions, right? So that's important. So we want to be able to apply the definitions that we learned there. We want to be able to apply them to the calculations. And then finally, there's going to be a little bit of recognition and disclosure towards the end. Okay, so that we're going to do basically after we come back from test 5. So that is basically what our objectives are. So things that we don't want you to follow or look for is going to be anything dealing with foreign operations. So wherever you read in your textbook or in your workbook foreign operations, you can ignore it. Okay, it's not important for you. Foreign currency transactions is not important. Okay. If we have a look at our agenda for today. So for today, what we're going to be doing is we're going to be going through the background, right? So we're going to be going through the background, and we're going to be going through a little bit of part 1. Part 1, unhedged. Okay, unhedged instruments. So we're going to be just doing that for today. We're going to continue on with part 1 after that, right? So just the background and part 1, and then part 1 will continue next week, and then the week that we return from the test, we'll do part 2. Okay, so that's where we're at. Now, let's talk a little bit about what we're doing, right? So we might have a company that buys inventory, let's say a $10,000 worth of inventory from a foreign supplier. Okay, but on the date that they bought it, the date that the transaction happened, let's say that was the first of the month, right? So that was 1 May, first of the month. They bought the transaction went through. They bought it, but now they don't pay that creditor on that day. They pay the creditor, let's say a couple of weeks later. Okay, but you guys would know because you watch the news, right? You know that we've got this thing called an exchange rate between rands and dollars. Now that exchange rate is going to change, right? That exchange rate is going to change very quickly. Okay, so that means that the rands that we bought this inventory for is not the amount of rands that we're going to pay. Remember, the foreign currency will stay constant. So the foreign currency, we bought it for 10,000 rand. When we pay, we're going to pay it for 10,000 rand. But the rand amount is going to change. When we bought it, it was at a certain amount. But when we paid it, the exchange rate changed over time, and therefore it was at a totally different amount. Okay, and in that situation, what's happened is the difference between what we bought and what we eventually paid is what we call a foreign exchange difference, right? It's called a foreign exchange difference. It means the difference between the transaction date, or the date that the thing was bought, and the date that the thing was paid. And the date that the creditor was paid, at least. So that difference is what we're trying to calculate, what we're trying to get at. Okay, that's what we're doing here. And then in some situations, we have a situation where your financial statements need to be presented to, let's say, a foreign bank, or let's say a foreign investor that wants to buy into your company or something like that. And that might mean that you need to present your financial statements in a different currency to the currency in which you do business, right? So let's say you do business in South Africa. So your business currency, we're going to give that a name just now, right? We're going to start calling it functional currency, right? But the currency that you do business is in rands. But now you've got a parent company or an investor in the USA. So now you need to present your financial statements in dollars so that he or she understands, okay? Because they won't understand rands. So that is those are the types of things we're going to try and do in this topic, right? So that's what we want to do in this topic. Okay, so let's have a look at this definition of functional currency. So like we said, functional currency is the currency in which you do business. Okay, so write down in your notes, functional currency equals the currency in which we do business. Okay, now if you have a company that is situated, let's say, in Joburg or Pretoria, and they're doing business, what currency do you think they're going to use in the majority? What currency would they use? Pop your answer into the chat. All right, what currency do you think they're going to use when they're doing business in Joburg or in Pretoria? What is the majority currency that they're going to use? Sure, sounds like no one knows. Can everyone hear me, Kelly? Am I? There we go. I was concerned. I thought everyone had left. Yes, we're going to use rands, right? Now, would you accept that that company has no control over what currency is used in South Africa? So any company, right? Can they change the currency of South Africa? No, right? They're not going to say one day, oh, it would be nice if we could do business in the Botswanian pula. It's not possible, right? So the functional currency an entity does not have control over, right? It is simply the environment dictates the functional currency. Okay, so whatever is the area of primary business, when I say primary business, I mean the most amount of revenue, at least, that they get from their customers, and the most amount of payments that they make. Right? So whatever is the primary amount of payments that they make. So if the primary amount is in rands, even they might make a little bit of payments in dollars, but the primary amount is rands, and the primary amount of sales that they make is in rands, then their functional currency is rands. Okay, and so what we say is, in order to measure certain balances and amounts in the financial statements, we use rands. Now this is important. This word measure, right? So measure. What we're saying there is that our T accounts and our journal entries are passed in this currency. Our T accounts or journal entries are passed in the functional currency. Okay, because we measure. Remember, when we're doing T accounts and journal entries, we're trying to measure. We're trying to have an accounting treatment for what we're measuring, and so those types of things will be done in the functional currency. Okay, and like we said, the entity has no choice over what the functional currency is. Instead, the environment dictates the functional currency. Now, this is important because we're going to look at something different now when we talk about the presentation currency. So, would you accept that not every journal entry on the balance sheet, right? So, in the financial statements. Because think of it, what happens is we might pass, let's say, a journal entry, then we might reverse it during the year, like that leave pay thing, right? So we reverse it, and then we might, pass a different journal entry, and then we might put something into an expense account, which is zeroed out and goes to zero at the end of the year. So not all the amounts that go into these various accounts will be presented on the financial statements. They will have some effect, but they won't be presented as individual figures. So the presentation currency is the currency in which we prepare our financial statement, whereas the functional currency is the currency in which we measured all of those various transactions, right? So all of the various transactions were measured in the functional currency. But then when we group them together and put them on the financial statements, we're then going to use the presentation currency. Okay, so we can use two different currencies. We're going to explain why in a second when we look at an example just now. So if that is the case, there's three things that we need to disclose. So if that is the case, where our functional currency is different to our presentation currency, we must disclose three things. First, the fact, meaning the fact that we have a different functional currency from presentation currency. So we must explain which currency is presentation, which currency is functional, and sort of then why, right? So we need to explain why this is our functional currency, right? So it must explain why it's our functional currency, and if there is a reason, what is the reason for presenting in a different currency to the functional currency. So what is the reason to use the presentation currency? So we need to explain the fact that there is one, then we need to explain why those two currencies are involved in our financial statements. Okay, so now let's have a look at this example. So we have a company in Mexico, right? So that's the dude in the center, right? So that's the dude there, right? So we have that company in Mexico. And in Mexico, what currency do they use? They use the peso. They use the peso in Mexico. Okay, so we have that currency, and they're doing the majority of their business in the peso. Okay, but then they might have a situation where they buy or sell something to a foreign entity. okay, a foreign entity, let's say in Germany. So if this entity in Germany, let's say, bought something or sold something, we would need to exchange our pesos with the euro because that person is from Europe, right? So Germany would use the euro. So we need to exchange our pesos, right, for that European currency, okay? But the same entity in Mexico has a um, parent company that sits in the US, and the US obviously use the dollar, the US dollar. So we have a situation where the majority of their sales are happening in pesos. They engage in some sort of what's it called, transactions with Germany, and they use the euro. They need to present their financial statements in the dollar. Okay, can you see how that can happen, right? Can you see how this situation can present itself? And they're presenting it in the dollar because they have this American parent that wants to include and wants to do a group consolidation for this company, okay, for this foreign company. Okay, so that is what why we need different types of currencies and why we have different types of currencies. I'm going to explain something to you, and don't forget this diagram because we're going to come back and I'm going to ask you a question. Okay, so a foreign currency, right? So far we spoke about functional currency, presentation currency. Now we're speaking about a foreign currency. A foreign currency is any currency, right, that is not the functional currency. Any currency that is not the functional currency is a foreign currency. And then if we have a transaction that takes place in a foreign currency, we are said to have a foreign currency transaction. Okay, we said to have a foreign currency transaction. Now, we can buy, we can sell, we can have assets, we can have liability sometimes. If we got into a loan, we can have liabilities. If we sell, we can sell assets. So there can be so many ways in which we can engage in such foreign currency transactions. Okay, now let's look back at this diagram. So if we look again at this diagram, can you tell me which is the foreign currency? Type out in the chat. So here we've got the German using euros, we've got the entity using pesos, and we've got the US using the dollar. Which is the foreign currency? Type out your answer into the chat there. Which is the foreign currency? I'll give you a minute. Yes, that's correct. So the euro is the foreign currency. Euro is the foreign currency because it's not the currency in which they do the amount of business. They do some business, but not the most amount of business. It's not the currency that is used in Mexico, right? And therefore it's the euro. So I've got another question. Can we have a situation in which the dollar, the US dollar, can be a foreign currency? And the answer is, if you have a look at that definition, let's go back to that definition. If you have a look at that definition here, any currency other than the functional currency. So answer yes or no for me in the chat. Can the dollar, in our example here, can the dollar be a foreign currency? Yes, correct. The dollar can be a foreign currency. Okay, so it can be both the presentation and a foreign currency in this case. Okay, so that's important. Okay, so far we are talking about different rates. We're talking about different what you call it, currencies, and then we got onto the idea of a foreign currency, right? So So when we start talking about a foreign currency, we have this thing called an exchange rate. An exchange rate. Okay. So an exchange rate is the rate at which one currency can be another currency. Okay, or let's use a better word is converted. One currency can be converted into another currency. That is what the exchange rate is. Okay. Now the exchange rate is actually something that is affected a lot by the market. Okay, so it's affected by each and every individual buying and selling many things many times in a day. Okay, and because that happens, we have what we call the spot rate, right? So the spot rate is at the bottom there. We have what we call the spot rate, and the spot rate is the exchange rate at a given time in the day, and it changes from minute to minute. Okay, the spot rate changes very quickly, sometimes even less than a minute. It can change. Okay, again, it's the exchange, it's the rate at which we can convert one currency into another currency. Now, the spot rate is what happens in the market. But if you want to buy, right? If you want to buy a foreign currency, you can't just walk up to the market and buy foreign, because the market is not in a specific place. Okay, it happens between banks, between very big banks, right? And the way these banks buy and sell, they use a different rate to buy and a different rate to sell. So when they're selling it to you, that means you giving them rands and they are giving you, let's say, dollars, right? So when they're selling it to you, they will sell it to you at a rate that is higher than the spot rate, right? So it's the spot rate plus something will give you the selling rate. Okay, so it's higher. Why are they selling it to you higher than the spot rate? Because they want to make a profit. Okay. Now, let's say you went on holiday and you came back home and you still had a couple of $100, right? So you bought it at the selling rate, you went on holiday, and then you came back, and now you still have some remaining. So you want to actually sell it back to the bank, right? When you try and sell something back to the bank will buy it from you at what's called the buying rate, right? And now the buying rate is also going to be the spot rate plus something. Why will it be the spot rate plus something? Because they want to make a profit. Okay. Now, sorry, I made a mistake. The buying rate is not going to be spot rate plus something. It's going to be the lower than the spot rate. So they want to buy it for cheap and sell it for lots, right? So they're gonna take the spot rate and minus something from it, so that they can sell it at the selling rate for more money and make money. Okay, so they buy it from you at a cheap rate and they sell it back to you at a much more expensive rate. Okay, and that's how they make a profit. Okay, now let's just take a break from the definitions. What do you mean by entity? I just simply mean a company. When I'm lecturing, the entity is that you can change you. You know, when I'm lecturing, I'm saying you buying it. You can change that you into the entity. Entity just means a company. So the company wants to go to the bank and buy it. They'll buy it at the what's called the selling rate. The company wants to now sell the foreign currency to the bank. They're going to sell it at the buying rate, right? Okay, so they're selling it back. So it's basically from the bank's perspective. The bank is saying, we're selling you the currency at this amount, and we'll buy the currency back at this amount. So let's have a look at some of these rates, right? So we're going to take a break from a little bit from the definitions, and I just want to show you some of these rates. So if you have a look at Bidvest, Bidvest is willing to sell to buy your notes, right? When they say notes here, they're talking about hard cash, so paper money, right? They're talking about money, like real money. Under this last two columns where they say we buy, we sell, that they're talking about digital money, so money in the bank account. So when you go to your bank account and you see all those zeros, all of the millions in your bank account, they're talking about that here. But when they say notes, they're talking about the actual hard cash. Okay, so they'll buy it from you at 15 Rand 20, but they'll sell it to you for 16 Rand. So they're going to make that profit. See, they're selling it to you for more than they're buying it from you. So they're trying to make that profit on those amounts. And then similarly with all of the other currencies, and then it's slightly cheaper when you want only digital currency because they don't need to actually have the notes in South Africa for you, right? Otherwise, they're going to need to ship the notes in. Okay. So very similarly here, the buying rate is the rate at which is the profit called spread? It is, but I think we might be getting confused with Forex trading, which is not what we're doing here. Here we're actually buying real currency, whereas in Forex trading, you're dealing with what's called a derivative or an option. Okay, so that's slightly different. When you trade Forex, you wouldn't receive in the mail real dollars. Okay. Okay, so back to the definitions. So at the end of the year, when we want to translate our financial statements, we want to have what's called the closing rate. The closing rate is basically the spot rate at the end of the day after the last trade. Remember I said that the spot rate is affected by different people trading and doing different things during the day. The spot rate then will change throughout the day, but at the end of the day, when the last trade is done, you call that rate the closing rate. And when we're translating our financial statements, we want to try and use that rate as much as possible. Okay. The next rate is a rate that is important, and please, guys, try and remember this. So this we're only going to be doing after the test 5, right? So it's going to be about 2 weeks before we look at this again. The forward exchange rate is the exchange rate that a bank will sell you currency in the future, right? So it's an agreement basically. So you go to the bank and you say to the bank, I want to buy so many dollars, but I don't want the dollars now. I want them in 2 months' time. Okay? And so the bank enters into agreement with you and says, okay, we're happy to give you the dollars, but we will charge you this thing called a forward rate. Okay, we're going to charge you this thing called a forward rate. And it's simply an agreement. And that's why you'll see when we start doing, when we start looking at it after test 5, we're going to call it foreign currency transactions or foreign currency contracts, because it's simply an agreement. Okay, it's simply an agreement between you and the bank. And you make an agreement to buy something in the future. So we can state the rate in 2 different ways, right? So we can state it in what's called the direct quote or the indirect quote. So what does this mean, the direct quote? The direct quote means you say, I need rands to buy this foreign currency, right? I need so many rands to buy this foreign currency. And what you will notice is that the rand amount, so if we look down here where I've made that red line, so the rand amount is on the right side of the 2 dots. Right? The rand amount is on the right side of the 2 dots. And generally, the rand amount is high. So just because the rand is so weak. So you'll see here it says 12 rand 50 for $1. Okay, so it's the amount of rands you need to buy one foreign currency, one unit of foreign currency. Okay, so that is the direct quote. Now the indirect quote is the amount of foreign currency you get for 1 rand. Notice, so let's just say that again. So the direct quote is the amount of rands you need to buy 1 unit of foreign currency, right? That's a direct quote. The indirect quote is the amount of foreign currency you get for 1 rand. Okay, and this is what that specific indirect quote looks like. So the rand amount is in 1 unit. Right? Can you see that the rand amount is in 1 unit, but the foreign currency amount is in a multiple? It's 0.00 something. Okay, so that is different. When you get your questions, please, guys, you won't believe how many students make this mistake. You have to identify if it is direct or indirect. You have to do that. It's so important, and so many people make a mistake. Why is it important? Because when you're dealing with the direct quotation, you are going to multiply or times the value of foreign currency. Okay, you're going to multiply or times the value of foreign currency. When we deal with the indirect quote, we are going to divide the foreign currency. Okay, any questions so far? Does anyone have any questions about the different ways to quote currency? Have you seen something like this before? Are you familiar with this? Yep. Okay, great. Okay, so let's have a look at this scenario, right? So in this scenario, I'm just going to give you a rundown, right? So a very quick thing. We're not going to read the whole thing. So we've got 200,000 US dollars that we need to pay for inventories, right? So we're buying inventories. We need 200,000 US dollars. We get 2 rates. Okay, so we get 2 rates. The first rate is a direct quote. How do we know it's a direct quote? Because currency is in 1 and the rands is in a multiple. Okay, so that's how we know it's direct. So when we're doing direct, what did we say we need to do? We need to multiply. Now, when the rands is in a single unit and the foreign currency is in a multiple, then we know that we have an indirect quotation and we need to divide. Okay, so let's have a look at what that looks like. Okay, so here again, I'm just saying, please just make sure that you identify that it is a foreign currency that's quoted indirectly. Okay, so have a look at what we've done. We have here, we have taken out 200,000. We've multiplied it by can see the multiply there. We multiplied it by the 14 to get the amount of 2 million. Under B, we took the 200,000, we divided it, see the divide sign, by whatever amount they gave us to get the 2.8 million. Right. Now, what is important and good exam technique is whenever you're writing anything, please, please, please write the currency for which you're writing it. Notice how we've always written the currency here. That's important because that's going to help you and that's going to help you to score marks. Okay, so please write the currency there. Okay, so back to definitions. So we're talking about this thing now called a monetary item. A monetary item. So what is a monetary item? A monetary item is, number 1, cash. Okay, that's easy, right? If it's cash, it's easy because we can identify, we know what cash is. So the first thing is monetary item, it's cash, right? The second thing is A monetary item can be something that is settled in a fixed amount of cash. Okay, settled in a fixed amount of cash or money. Okay, so those are the two requirements for monetary items. It's either or it needs to be settled or paid or received in a fixed amount. So the key here is, the key word is fixed or determinable amounts, right? So it must be fixed. Okay, so why are we saying it must be fixed? If it's fixed, it's not going to vary across time. So, like we said in the first example that we had someone who bought 10,000 Rand worth of inventory on the 1st of May, but they only paid it in the 31st of May. But when they bought it, it cost them $10,000. When they paid it, they also paid $10,000. Can you see that the amount hasn't changed? The Rand amount has changed, yes, but the foreign currency amount hasn't changed. So, therefore, when we're dealing with such cases, of creditors, we have to pay the creditor a fixed amount in a foreign currency. We're in fact dealing with what we're going to call a monetary item. Okay, we're in fact dealing with a monetary item. So when we say, so if we've got monetary items, we're obviously going to have something called non-monetary items. Non-monetary items are items that don't have a fixed amount of money allocated to them. So if you think of inventories, we might have an idea of what the cost of the inventory is, but the truth is we're not going to need to we're not going to know exactly the amount that we're going to sell them until we sell them. In same way, PPE, we can come up with the best estimates, but they're not constantly every day. There's nothing that we can look at that will tell us, okay, this is what the value of those inventories are, or this is what the value of that PPE is. So as a result, it's non-monetary. Okay. Any questions about monetary versus non-monetary? I'm going to assume everyone is okay. That is a key topic. But like I showed you there, I've already prepared a list for you on that slide, and I've put in the more popular ones. So you guys will be okay if you just read that list carefully. So unhedged. So what does hedged mean? So hedged means to protect something. So you guys will remember, or you guys will know the word hedged from when we talk about like a plant that forms a fence. Okay. So you have like this bush that forms a fence around a house, and we call that a hedge. Right. So it offers some sort of protection. So an unhedged foreign exchange transaction is a transaction that has no protection. Okay, an unhedged foreign exchange transaction, it has no protection. But it has no protection against what? Right? It has no protection against changes in the exchange rate. Okay, because remember, we can engage in a transaction and we need to pay 100,000 US dollars, and the exchange rate is, let's say, 17 Rand. Right? So we need to pay 100,000 times 17 Rand. Right? But when it comes date to pay it, so that was on the transaction date. When it comes to the date to pay it, it can now be a totally different amount. Right? It can either be 17 Rand slow, it can go down to 12 Rand, it can go up to 20 Rand. So because of that, we have some sort of a risk that we might possibly, lose some money, right? Because the exchange rate may change. So an unhedged item is an item with no protection against foreign currency risk or foreign currency fluctuations. Fluctuations means changes, right? So it has no coverage, no protection against any sort of foreign currency changes or risks. Okay, so that's what an unhedged item is. Now we're going to look at a few terms, right? The first term, very easy, is transaction date. Now you guys would be aware of this because when we did inventories and PPE, you would know what I'm talking about. So transaction date is the date at which risks and rewards transfer to and ownership transfers from one person to the next. Okay, so risks and rewards an ownership transfer from one person to the next. But the question is, let's say we're getting a shipment from the USA, right? So we're getting the shipment from the USA and it's coming on a ship. We put it on the ship and the ship is now sailing towards us, right? So when do the risks and rewards transfer? Do they transfer when they were loaded on the ship? Do they transfer when they were loaded off the ship? Do they transfer when the goods arrived at my door? Or do they transfer somewhere in between the Atlantic Ocean? Where do they transfer? So in order to resolve that problem of determining where they transfer, the world came up and economic bodies came up with a thing called shipping terms. Okay, so they came up with a thing called. Now, the two popular shipping terms that we're going to use and talk about is FOB, right? Now, there's lots of shipping terms, but we're only dealing with two. The first one is called FOB, which means free on board, right? Free on board. Why are we calling it free on board? It means because when we put the goods on board on the ship, we are free from any risk, right? So when the seller puts the goods on the ship, he holds no more risk. That's what free on board means. Okay, it means there's some risk when it's on the ship, free on board. So the risks and rewards transfer at the time that it's loaded. Now, people have gotten very technical about this. And what they've said is when it passes over what they call the ship's rail, right? Ship's rail just simply means the side of the ship, right? When it passes over the ship's rail, then it's free on board. But in back to 100, we're not going to get that technical, so you don't need to worry about it. But all you need to know is when it's loaded on the ship is when risks and rewards have transferred. Right. We've got another hybrid called CIF, right? CIF. So CIF is similar but slightly different, right? So what CIF says is the risks transfer at one time, but the costs transfer at a separate time, right? So the risks transfer when the ship is loaded and the ship leaves the harbor. So remember with free on board, we said only when it's loaded. So here it says it's loaded and it leaves the harbor. Okay. That's where it passes. So when it's loaded on the ship and the ship begins to sail away. But because that time period between loading and sailing away is so short, in back to 100, we're not going to worry too much. You guys can sort of treat it very similar. You can treat both very similar, okay? So, because the time period is so short here, it doesn't make sense for us to split hairs about it, right? And then under CIF, the seller pays for transport, but their risks don't continue, right? Their risks stop as soon as the ship is loaded and the ship sails away. Their risks stop. Okay, but for the most part, for our understanding, we know that it's basically a very similar time. Okay, now we're going to deal with so that first date was the transaction date. Right. What is right, a year-end date? So let's talk about the year-end date. So it says when we have a date, right, we need to remeasure any monetary items. So we need to remeasure any monetary items at the year end. Does that make sense? We need to remeasure any monetary items. Remember what we said monetary items was equal. But debtors we need to remeasure, right? Because the debtor amount might change. The loans might change. We need to remeasure any monetary items. Okay, we don't need to remeasure any non-monetary items because they would be, we take them in. Having problems hearing. I think we are problems hearing. For some reason, the internet. That the important part is remeasure all the monetary items, right? We that's very critically important. With regard to the transaction date, we sort of know that we need to measure it on the transaction date, right? We know that because on the transaction date, we've done transaction dates before. When we get the goods, let's say on the 1st of May, we bought the goods. When we get the goods, on, does this sound better? Can you guys hear me now? Is it any better now? Okay. Okay, cool. I just need to mute my other laptop. Just give me a minute, because otherwise you're going to get a feedback again. Okay, cool. So I'm going to use one laptop to write and the other laptop to speak. Okay, cool. So what I was saying was, what's important? So someone was asking, what were you talking about that was important? I'm trying to think about where we were. The risks and rewards part, I think you guys would have heard that. In terms of what's important, it's identifying whether something is monetary and non-monetary and knowing when to restate it. Okay, so if we have a look at year end, right, we need to restate our monetary items but not our non-monetary items. Our non-monetary items would only be restated and only be accounted for when we do our transaction date, which is easy. We just did that when we did that example with that 14 Rand, right? So we only need to restate our monetary, and it's very important that we identify which are our monetary items and which are our non-monetary items, because our non-monetary items are not restated. So this is what I'm trying to say here. So if we bought inventory, let's say on the 1st, right? And at that time, the exchange rate was for every $1, we had to pay 10 Rand, right? Then we have a situation where our inventory would have been, 10 Rand. Let's just say we bought $1 of inventory. So our inventory would have been 10 Rand. Now that's not going to change. The inventory is going to stay the same. But the creditor that relates to that inventory, when we eventually want to try and pay them, or let's say it comes to year end, they are now worth 15 Rand. We still owe them $1, but they are now worth 15 Rand because the exchange rate has changed. So that difference between the 10 Rand and the 15 Rand, we cannot call that a creditor. That's not a creditor. What that is a loss, right? It's a loss on foreign exchange transactions, because the only reason why that 5 Rand came about is because we were engaging in foreign currency transactions. Does that make sense? Does everyone understand that? So we need to record that loss separate from the creditor. We need to call that loss separate, record it separately from the creditor. So therefore, we need to restate it at year end. We need to restate it at year end. That's important. Okay. So now if we look at the next slide, what we're saying here is what we already said. So we don't want to restate the non-monetary items. We only want to restate the monetary items. Why don't we want to restate the non-monetary items? Because remember, non-monetary items are things like inventory, PPE. Those things work on what's called the cost model. So we only record them at cost. Okay. So therefore, we don't need to restate them. Okay. We're almost done. I know that we're a little bit over time. We're almost done, right? So again, now, when we have a settlement date, okay, settlement date is when you pay the creditor. So we've got this creditor. We recorded the journal entry on the day that we bought it. That was called the transaction date. Then at year end, we were forced to revalue the creditor only, not the inventory, the creditor only. We forced to revalue the creditor only at the year end. And then we got this 5 Rand, and we labeled that 5 Rand some sort of loss, right? So you can see the 5 Rand that I've circled in yellow. We've labeled it a foreign currency or foreign transaction loss. Okay. Now, yes. So monetary items. So if we have, I'm just going to go back. Just let me show you the slide. So if we look at our list of our monetary items. So what I did is I created a list for you guys so that now the slides don't want to load. I created a list for you guys to make it as easy as possible to find, to know what the monetary items are. So if we look at the slide here, everything that I've listed under monetary items are going to be the more popular things that we're going to be dealing with, right? So cash, debtors, creditors, loans, debentures, and interest. Whereas the other stuff is not as popular. So the non-monetary items are not. You don't need to revalue them at year end. You only need to revalue the monetary items at year end. Okay. Okay, back to our slide. So we say now, so we recorded a non-monetary item, which is our inventory, but we still got our creditor, which is a monetary item, and we need to revalue that monetary item. So we need to revalue it again just before we settle it. Settle it means pay it. Why do we need to revalue it again before we pay it? The reason being, because that difference of 1 Rand is not a value that's attributable to the creditor. It's not actually the creditor. The only reason why that 1 Rand has arose and came about is because we were engaging in a foreign currency transaction. Okay. That's why we need to measure it separately, right? And so what we do is we restate, or we remeasure it from one time to the next. So we remeasure it at the year end, and then we remeasure it again at settlement date, right? Any differences, so when I say any differences, I'm talking about the 5 Rand and the 1 Rand. These differences go to gain or loss, depending on what direction it is. They go to gain or loss in the statement of profit and loss and other comprehensive income. Okay, now I know that we went very quickly through this lecture, and we also had some technical issues. But in the upcoming lectures, I'm going to demonstrate what we've been talking about. So guys have been asking for examples. In lecture 2 next week, Tuesday, we starting with examples. So we're going to try and put what we've learned, the theory part of what we learned, into practice next week. Okay, so what I'm going to do is I'm going to stop the recording for now.